Ladies and gentlemen, good day and welcome to the Q2FY22 earnings conference call of LIC Housing Finance hosted by Axis Capital Limited. As a reminder, all participant lines will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Praveen Agarwal from Axis Capital. Thank you and over to you, sir.
Thank you, Stephen. Good morning, everyone, and we welcome the management of LIC Housing on this call. We have with us Mr. Y. Vishwanath Gaud, MD and CEO, and Mr. Sudipto Sil, CFO, to take us over through the results. Mr. Gaud, we request you to share your key highlights for the quarter gone by, and thereafter we'll open the floor for Q&A. Over to you, Mr. Gaud.
Thank you, Praveen. Thank you. Very good morning to every one of you, and I welcome to this post-earnings investor call of LIC Housing Finance Limited. As you are aware, LICHFL declared the Q2FY22 results yesterday. Before beginning, I wish you and your near and dear ones a very good health and safety. With gradual improvement in the pandemic situation and increased pace of vaccinations, it is heartening to note that normalcy is returning to our lives, which is also reflective of the pickup in business activities and the economic growth. With the greater relaxations of restrictions, sentiments have also improved very significantly. It is in this backdrop that our business was conducted in the Q2 of FY22. The key highlights of this quarterly results are as follows. The total revenue from operations 4,708 crores against 4,969 crores for the corresponding quarter of the previous year, with a decline of 5.25%. Outstanding loan portfolio stood at 2,37,660 crores against 2,13,349 crores as on 30th September 2020. It is reflecting a growth of 11%, out of which individual home loans have reported growth of 15%, and now it comprises a little more than 79% of the total portfolio. It is up from 76% a year ago. The total disbursement for the quarter were 16,110 crores. Out of that, the disbursements in the individual home loans were 14,330 crores against 10,373 crores, with a growth of 38%. Disbursements in project loans were 353 crores. The net interest income for the quarter was at 1173 crores as against 1,238 crores. Net interest margins for the Q2 FY22 stood at 2% as against 2.2 for the Q1 of FY22. Profit before tax for the quarter stood at 308.95 crore as against 1,009.26 crore. Profit after tax for the quarter stood at 247.86 crore as against 790.90 crore for the same period previous year. Loan disbursements during the quarter was extremely robust, with total disbursement at 16,110 crores, recording a growth of 29%. Individual home loans too continued its strong growth and posted 14,330 crores against 10,373 crores in the Q2 of FY21, a growth of 38%. Growth was uniformly spread across all geographies and across both large and smaller centers, especially Tier 2, Tier 3. It is extremely encouraging to note that we have achieved 132% of the pre-COVID levels in terms of our Q2 disbursements when we compare it with Q2 of 1920. On the portfolio growth front, the total portfolio recorded a growth of 11%, and now it stands at 2,37,660 crores. With increased focus on the home loan segment, the growth recorded in the home loan portfolio was at 15% for the quarter. In terms of asset quality, Stage 3 exposure at default as on 30th September 2021 stood at 5.14% as against 5.93% as on 30th June 2021. In our earlier interaction with you after Q1 results, we had assured our stakeholders that we strongly believe that a peak has been marked and subsequently asset quality would improve. It is very much heartening to note that stage 3 assets have declined by over 1,500 crores from Q1 of FY22 levels on account of strong effort put in by all the concerned. We have now a very strong confidence and conviction that the coming quarters will show greater improvements. This quarter, despite a reduction in stage 3 assets, the provisions have been increased to reflect higher PCR. Total provisions as on 30th September 2021 stood at 5,354.9 crore, reflecting a provisioning covering ratio of 43.72 on stage 3. It is up almost all by 9.72% as of June 2021. OTR during this quarter stood at 2,141 crore, lower than Q1 figure of 2,350 crores. We have been very closely focusing on the collection efficiency. That has also shown improvement and now stands at 99% for regular accounts, the highest since the pandemic broke out in March 2020. On the funding side, we have witnessed reduction in the overall cost of funds by 12 basis points during the Q2FY22, despite a hardening in the bond yields during the same period. Incremental cost of funds has come down by 13 basis points and stood at 4.9% for Q2 of FY22. Net interest margins for the quarter stood at 2% as against 2.2% over the last quarter. The decline being attributable due to income reversals on OTR accounts. Then incremental spreads continued to remain at healthy levels and stood at over 230 basis points during the 6 months ended 30th September. During this quarter, the company completed the preferential issue of equity to its promoters, LIC of India, amounting to 2,335 crores. This will add to the Tier 1 capital of the company. During the quarter, the company also tied up with the India Post and Payment Bank for distribution of its home loan products. With this brief introduction, I would like to invite you for your queries. Thank you very much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yes, sir. Thank you for taking my question. Sir, I have 2 questions. The first one is on your NIMs. So you reported a 20 basis point QOQ decline. And sir also suggested that these were income reversals on OTR accounts. So sir, if you can kind of briefly explain why these income reversals on OTR accounts, what were the nature of these restructurings which warrant income reversals, and what was the quantum of income reversals that we have taken during the quarter?
Can you come up with your second query so we can address both them together?
Yes, sir. Sir, maybe the next 2 is, now, I understand we kind of discussed during the last earnings call as well that, employee expenses will go up, but what is the nature or what is the run rate of employee expenses that we can kind of expect going ahead? And lastly, on your provisions during the quarter, while we highlight that our stage 3 numbers have actually kind of improved on a QOQ basis, but what is it that kind of warrants increase in provision cover? I understand we used to run a high provision cover during the past quarters. But sir, why I ask this question is, during every earnings call, when we kind of ask you, we typically get to understand that based on your assessment, at that point in time, the provisions were adequate. But what has changed, during this quarter that, you think that, there is a need to improve the PCR while, asset quality has actually improved? Or should we think of it like this, that because we were still working on that preferential equity capital raise, we were not able to take provisions, and which we have taken during this quarter?
No, one thing just I would like to, I think your questions were, 2-3 questions were there. As far as the provisioning is concerned, I would like to clarify you that, because every quarter, of course, last quarter, if you see the provisions were higher side, maybe around more than 800 crores. This quarter it is slightly less to 600 crores. Here what happened, no, the OTRs, especially where our OTR is nearly 3.5%, almost all, it is more than 3% of our loan book size if you look into that. And mostly now in this quarter it has happened on the retail segment. So nearly 2,100 crores were added this year, actually this quarter compared to earlier quarter. It has come down, but overall the provisioning of even 10% minimum required to be made on the whole the OTR thing. And moreover the stage 3 OTRs were taken care of full. So that what happened, we are adequately provided for. So no need to have any what you call no future, any some sort of what you call uncertainty. So our now NPAs, now we are very comfortable that compared to last quarter, the actually what you call the NPA amounts have come down by more than 1,500 crores if you look at in the retail segment itself. And in the project, mainly in the developer side, our loan book is only 6% and odd. So there what happened, more or less not much of addition to the NPAs are there. So we are very comfortable now as far as the what you call the asset quality is concerned. Last time also we told you very clearly that the worst was behind us. The similar way now it has been proved that yes, the recovery now we have improved, and then our teams are still on the what you call improvising our even all the levels at our collection efficiency also. Now if you look at the regular cases where our collection efficiency is more than 99% also. So I am very sure that the provisions what we have made are adequate enough, so that what happened, the provision coverage ratio also will be more than 43% now. And then as far as the other 2 items are concerned, I think CFO will tell you.
Yes, Abhishek, actually 2 things. Of course, what our MD sir mentioned about the provisioning also, if you see there has been a secular improvement in the GNPA, but of course there has been an increase in the provisioning cover. So as a result of that, around 600 crores of provision has happened. The other thing is that your query was regarding the margins. See, actually margins, if you look at it, there has been a reversal of interest. Now what happens, I'll explain to you. This at the end of September, the total amount of loans under one-time restructuring 1 and one-time restructuring 2 put together is around 7,300 crores. Now for that 7,300 crores OTR, because of the OTR given, there is a recalculation of the IRR and the effective interest rate, because of which there has to be an interest reversal which happened. This is a notional entry that has happened because of the OTR impact, and that is the reason why, and the impact of it to the tune of around 250 crores for the quarter ended September. The corresponding figure as of end of June with 5,300 crores of OTR was around 116 crores. So around 135 odd crores of extra reversal of interest has happened in the Q2 itself. Now what is the impact of it on the margins? For every 100 crores of loss of net interest income, the impact on NIM is to the tune of around 16 to 17 basis points. So for 135 crores of such reversal, the impact on the net interest margin in terms of basis points will be clearly in the range of around 20 to 23 basis points. What is also to be noted, very important thing, is that sequentially there has been an improvement in spreads. As our MD mentioned at the beginning of the discussion, that there has been a reduction in the cost of funds, both on the incremental side and both on the cumulative side by around 12 to 13 basis points between the 1st July and 30th of September, despite the fact that interest rates have been hardening in the system. Sequentially, there is a drop in the interest cost, which has resulted in an improvement in spreads. But because of this reversal of interest income, that is the reason why there is a drop in the reported net interest margins. Third question regarding expenses. Your third question was regarding the expenses. I think expenses, there has been a couple of one-time which has happened in Q1 last quarter. that we had explained because of the payment of arrears. This time also there is an impact of actuarial valuation on retirement benefits to the tune of around 45-46 crores. So if you net it off, then the normal increment in the other expenses should be in the range of around 15 to 20%. That should be an ideal run rate.
Got it, sir. This is useful. And so because this interest income reversal on the OTR book is notional in nature, would you say that because interest kind of continues to accrue, you will maybe see some interest income write back in the coming quarters?
As and when these accounts come out of OTR.
Right, sir. Thank you. And so lastly, if you could just share
to notice that now the OTR has ended.
Yes. So when these accounts come out of OTR, we can expect some interest income write backs from these OTR accounts.
Correct.
And so lastly, if you could share some color on the segmental asset quality which you kind of typically share during the earnings call.
Yeah.
So your individual home loans,
yeah,
your developer NPA.
I will read out the comparatives. Our MD will just give the comparatives. We'll request everybody to note so that we don't have to repeat it again.
Yeah, as far as the position at the end of September is concerned, IHL segment, stage 3 comes to 2.25%, and in the non-housing commercial, it is 14.83%. Then non-housing individual, it is 9.76%. So this is as far as the individual total is concerned. Then in the project, that is the developer book size, there the NPA levels, the stage 3 is at 23.94. Then overall, if you see our total NPA, gross NPA compared to last quarter from 5.93, it has come down to 5.14 now.
Yes, sir. So which is to suggest there were no resolutions during the quarter in your developer book.
Developer book resolutions were not there, ma'am, because developer book maybe small, one or two, may not have much impact.
All right, sir. Thank you so much, sir. I will come back in the question queue if time permits.
Thank you. The next question is from the line of Aditya Jain from Citigroup. Please go ahead.
Thank you. Could you tell us the current classification of the restructured loans? So the total outstanding restructured loans about 7,300 crores. Where are they classified now in stage 1, 2, or 3?
See, most of it is either in stage 1 or stage 2. Because when we are doing OTR, when the condition of OTR is that they have to be standard assets.
Got it. And is it okay to assume that it's largely in stage 1 as you had said in the last quarter, or is there a sizable amount in stage 2?
Yes.
Got it. Okay. And like you've done in this quarter in stage 3, increasing the coverage, is there a view on the stage 2 assets that the coverage there, is it enough, or would you take another chance to beef that up also to create more security cushion?
No, in the stage 2, the provisioning coverage is adequate. Considering the underlying valuation, it is adequate.
Got it. Thank you.
Thank you. The next question is from the line of Zuan from Point72. Please go ahead.
Hey, thanks so much for the opportunity. Sorry, just on the yield, asset yield part, it seems like Q-on-Q decline is about, if my numbers is right, about 35 bits. So the increase in interest reversal this quarter is 135 crores, right, which accounts to about 20 bits of that decline. So why is that the right calculation? And also, what accounts for the remaining 15 bips also of decline Q-on-Q?
No, I think, Zuan, what I understand from your observation, this quarter the NIM is 2%. What it was in June was around 2.20%. And what I mentioned in my earlier discussion is that for 135 crores of interest income reversal, the impact is around 22 to 23 basis points. So that actually takes us notionally adding back to more than what it was in the June quarter. Now, what is to be also noted is that the total impact of reversals in totality is 250 crores. The increment is 135 crores. So if you add back a 250 crores notionally, then the number actually reaches much higher.
Right, got it, understand. Right, and on just on the home loan yield side, do you mind give us some color on, what's our current average home loan yield versus, because I think our new rate is at 6.6% or something. Just want to understand, how much repricing is potentially in the future, or is that mostly done?
No, as far as the rate is concerned, now the 6.6 is the entry level what we're offering, really going on well. I think even the volumes are picking up very well in the last quarter. You can see good growth rate is there. In the disbursements also, I think we have shown more than nearly, already we reached the pre-COVID levels as far as the quarter is concerned. And that way, good traction is there across. And then this 6.6 is also will give, because it is linked to the what we call CIBIL scoring. So our actually selection will be very, very sound enough to take care of the 6.6 is what we are offering only to the selected customers, that to the best customers based on the credit score.
Okay, so got it, understand. So lastly is on this coverage, provisioning coverage. Do you think, are we comfortable with current level of coverage, or we are, given the capital raise, we are more comfortable to continue to increase that coverage going forward? And if that's the case, do you have like a target or ballpark number in mind?
This coverage, I think now it is full. It is very much adequate. What at this level, going by the valuations, it is. I think earlier was only 34 like that. Now it has come to 43%. Almost all 9% increase is there, and mainly it will take care fully what we are now at this level. I think we, from our side, it is almost all fully provided for, because NPS also, you see now they have reduced. Another favorable point is over the last quarter, the volume of even non-performing assets also have come down by nearly 1,500 crores. That also added to this. It is a very good positive trend. So further provisioning may not be much on the higher side.
Got it, understand. So we are adequately covered right now. Sorry, just a follow-up. Sorry to come back to the NIM question. Maybe I'm missing something, or I don't really understand this well, but if I look at the increase in OTR, right, so last quarter is, I think, 1 percentage point or so of the book. And this quarter we have about 0.8%, 80 bips of increase in OTR, and we have less slippages this quarter. Why would the income reversal this quarter be higher than the last quarter though?
The reason is that the income reversal is on the total outstanding OTR, which has increased by 50%. So earlier the interest was only for 3 months on 5,300 crores. Now it is for the 6 months, and for the 6 months it is 7,300 crores.
I see, got it. So that means that that pressure on the income reversal may not increase quarter on quarter going forward, since we are already kind of, our restructuring is peaked. But that income reversal absolute amount, it will still be there going forward. Is that the right way to understand it?
No, the OTR scheme has now ended.
No more additions will be there, one thing. Secondly, the OTR things also may be coming out of that. Yeah. Because we are now what we call, we are after this all the borrowers, so that what happened, people can avail. Then who are now actually the income levels are better off. Now the what we call, people are getting salaries in time. So definitely when our book is, actually our portfolio is mostly on the salaried structure, we are very, very sure that many borrowers will come out of the OTR in this quarter. Certainly, because there are in that stage 2, even stage 3 also definitely come to stage 1. That way there will be an improvement. I think we don't see much of the what you call requirement of the reversal on the higher side.
Got it. Understand. So just to understand perfectly, so as long as the account is in the OTR, it will still have income reversal going forward. But once they start to come out of the OTR, i.e. OTR start to decline, then the income reversal during that quarter will start to decline. Is that the right way to understand it?
Yeah, I think, see what we mentioned is that there will be no further addition to the OTR pool. It is actually coming down.
Got it. Understand. Thank you so much.
Thank you.
Thank you. The next question is from the line of Subhranshu Mishra from Systematics. Please go ahead.
Hi, sir. One,
Mr.
my
Mishra,
understanding
sorry,
we can.
your voice is breaking up, sir.
Hi, am I audible?
Now you.
Yeah. So I just want to understand this interest reversal, sir. I think we can only do interest reversal as per NDS in stage 3. If most of our OTR is in stage 1 and stage 2, how have
No. That is not correct. That is not correct. Whenever there is a restructuring which happens, it changes the term, the total tenor. So the moment that happens, the EIR, effective interest rate, and the IRR also changes. And when that happens, obviously there is a derecognition of the income which has to happen to reflect that change.
Right, sir. But as per NDS,
that is Ind AS only. I'm talking of Ind AS only.
Okay. Okay.
This has happened not because of a stage 3 impact, but it has happened because of the fact that the effective interest rate has changed because of the elongation of the term.
Got it, sir. And sir, what is the split of the book between the top 7 cities and other cities, sir?
If you look at our portfolio also, mostly even in the traction now where we are seeing in the last quarter, nearly 50%, more than 50% is coming from the tier 2, tier 3. So if you look at the metro cities and all top 7 cities, it is around 58% of the portfolio.
So the number of offices and the split of the book is similar, sir?
That you will find in the presentation. If you want, I can just repeat the number. You want the number of offices?
No, not number. The split of the book.
Your voice is not very clear. Just giving you, there are 85 offices in the top 7 cities and 197 offices in the other cities. Top 7 cities are the Mumbai Metropolitan, then NCR, Mumbai, Pune, Chennai, Hyderabad, Kolkata.
And add to that, our recent tie-up with IPPB also will make our reach far better in tier 2, tier 3 especially.
So what I'm trying to understand is what is the split of the book, not the offices in top 7 cities and the others. That data is available.
Coming to 50, see our book size, if you look at geographically also, top 7 cities account for nearly 58%.
So 58% is
if you look at the present year, what happened now, 43% of the business has come from top 7 cities and 53% has come from the others.
Sure, sir. And just one clarification from the notes that there are 248 accounts which come from which are in from OTR 1, which have been again put in the OTR 2. If I calculate the average ticket size there, it's roughly around 72 lakhs, which means that the average ticket size in OTR 2 would be around 35 lakhs. Sir. What is the difference here, sir? Why is the ticket size higher in OTR 1 and why is it lower in OTR 2, sir?
See, actually, if you look at the way the OTR has happened, majority of the corporate account OTRs had happened in the 4th quarter of last year and the 1st quarter of this year. Whereas in the 2nd quarter, the large ticket project loan cases were very, very small. Hardly some 4-5 cases had come, whereas a good amount of retail loans had come for OTR in Q2, in the under the OTR 2.
Sure, sir. No question. I'll come back and.
Thank you. The next question is from the line of Kunal Mehra from MLP. Please go ahead.
Good afternoon, gentlemen. Thank you for the opportunity. One question. Given the incredible step up in OTR 2. Would you be willing to share with us how the OTR 2 and 1 book split between the individual housing, commercial, or individual non-housing?
See, we have got the details of the individual and the project. I do not have the individual home loans, non-housing corporates and other breakdown. Just to give you, if you want quarter-wise, I can give you quarter-wise. First quarter, about 2,070 crores was under the builder loan category, and about 275 crores was under the retail category, which comprised mostly of the non-housing corporate and the non-housing individual and home loans. These are the three categories there. In the second quarter, the project loan was only 62 crores, whereas 2,078 crores, that is 2,078 crores, was in the individual category, comprised of all the three sub-segments, that is NHC, non-housing commercial, NHI, non-housing individual, and IHL, which is individual home loans.
And that's really helpful. Thank you. And if I was to qualitatively ask you about this 2,078 crore split in the individuals between the non-housing, commercial, non-housing, individual, and individual housing, directionally, which one would be the largest contributor to this? And the reason, I'll be transparent, the reason I'm asking is I'm trying to handicap the odds that roll forward and we have another one of these, slip on account of the nature of the underlying asset versus the stress they're experiencing in the real economy.
This is mainly due to the retail only. All our 2,078 crores, what you have mentioned now, the OTR 2 in the last quarter is only from the retail segment. The ticket size may be around 25 to 30 lakhs. That's our average size. That is the thing.
Got it. And therefore, sir, given that the dominant share is retail, it is 25 lakhs, it is arguably, non-salaried retail. When you restructure these kind of...
Not salary.
It could be salaried retail also.
Our loan book, if you see, in the individual housing loan also, more than 75% of our individual house loans are all salaried class only, because all our CIBIL based, all things are there. So, and then moreover, our teams are working to bring out these people also out of OTR. So, with the facility of this, some concessions given, and then going forward, actually, these numbers will come out of the OTR, suddenly will give a lot of fillip. If you look into the collection efficiency also now, for the regular accounts, already it is 99%. The best we have seen in the, I think, even pre-COVID level like that.
So just to give a little bit more color there, your query is that probably you would like to know why there has been so much of people going in for OTR 2. Now let us look at the backdrop on which the OTR 2 was announced. It was at the time of the second surge, second wave of the COVID. And that point in time, is something which we had shared earlier also, at certain times it is from the customer, individual customer, or even for the commercial customers, what is more important at that point in time is to preserve cash. So as and when an OTR offer has come from the government, that through the regulator, they had opted for it. Now, what is the probability that they will come out? If you look at the earlier year, last year, the moratorium, now 80% plus of people who had opted for moratorium at that point in time have come back on full recovery. I mean on full updated mode. So as and when the external situation improves, and it has already started improving, more and more people generally come out of these kind of OTRs. Or
even if you look at the Q1, Q2 movement also, actually those accounts which are there in the moratorium in Q1, they have come out. Some of them have come out and updated even fully also. That is also possible.
Got it. And of those accounts that came out between Q1 and Q2 from the OTR, was there any accompanying write back of the notional income reversal? Or due to this restructuring?
As of now, this is the, if you look at the statutory disclosures that we have made, total amount of exposure that was out of 7,398 right now, because the OTR 2 was mostly invoked towards the end of the quarter, there has not been much scope for people to come out of the OTR 2. As of 30th September only the implementation was going on. Now progressively we will see the outstandings compared to the invocation coming down.
Got it.
It will happen mostly in the individual segment. It will happen definitely. There is a positive on that.
Okay. Thank you again, gentlemen. Appreciate your time and patience.
Thank you.
Thank you. Before we take the next question, a reminder to the participants, please limit your questions to one per participant. Should you have any follow-up, may we request you to rejoin the queue. The next question is from the line of Kunal Shah from ICICI Securities. Please go ahead.
Yeah, hi. So the question is with respect to the stage 2 breakup. Last time we highlighted in the corporate developer it was 2,400 odd crores out of 12,000 crores. So how has been the movement in stage 2 between the corporate and the non-corporate? And also if you can share the non-individual, non-housing breakup of 35,000 crores, how it has moved this quarter?
See, first of all, the non-housing individual and non-housing commercial, in June, the non-housing commercial total was 14,300 crores and non-housing individual was 20,501 crore. So it was around 35,000 crores, 34,800 crores. As of September, the non-housing commercial is 13,600 crores, so it has come down by 700 crores, whereas the non-housing individual has remained more or less at that level, slight increase of 200 crores. 20,500 to 20,700 crores. And total, if you see, there has been a decline in the non-housing commercial and non-housing individual between June and September.
Yeah, and stage 2 breakup?
Stage 2 breakup for, I'll give you comparable. First of all, is that in stage 1, in the non-housing commercial, more or less it has remained same. In stage 3, there has been a decline, as we mentioned in the beginning. And stage 2 also there has been a decline from 1362 crores, it has come down to 1292 crores in stage 2. I'm talking June to September figure. And from 1927 crores, it has come down to 1507 crores. So there is a 400 crore reduction in the stage 2 also. And consequent increase in stage 1.
Sorry, stage 2, there was a decrease?
Come down. Yeah, it was decreased by 400 crores in the non-housing individuals.
Non-housing individual.
Yeah.
Okay. And the corporate, how would be the movement in stage 2?
Non-housing corporate also, there has been a reduction by almost 70-80 crores in stage 2 itself.
Okay, so that's it. Only 70-80 crores.
Yeah, so stage 3 and stage 2 both have come down in both these categories.
Okay. And just again to clarify in terms of this restructuring, so now the provisioning on this restructuring would have been rotated through impairment.
I missed out on the project. Project also stage 2 has been reduced. Stage 3, as we mentioned, has come down marginally. Stage 2 has come down from 2,490 crores to 1,553 crores. And stage 1
okay.
9,500 crores to a little more than 10,000 crores.
Perfect. So 2,490 is becoming 1,500 in stage 2 on the corporate developer.
Yeah.
Okay. And overall provisioning on restructure is routed through impairment allowance even in this quarter.
Yeah, as
per the policy. Yeah. Okay. Good.
It is that as we mentioned last couple of times, it is an appropriation for you now.
Yeah. Okay. Thanks.
Thank you. A reminder to the participants, please limit your questions to one per participant. The next question is from the line of Dhaval Gada from DSP Mutual Fund. Please go ahead.
Yeah, sorry, two questions. One, Sudipto, can you just give the absolute stage 3 for NHC, NHI and IHL? I just wanted to reconcile the number. And the second...
So we have given at the beginning of the
percentage, the absolute, if possible.
You want us to repeat the same numbers?
No, the absolute number. I think you gave the percentage. I'm just trying to reconcile the absolute for non-housing individual, non-housing commercial and individual home loan.
Stage 3. From 2.6, it has come down to 2.25.
Absolute, if possible. Or I'll take it offline. That's okay.
Yeah. Because we have already given all these numbers so many times.
Yeah. And the second question was regarding margins. So just to sort of summarize, you're saying that next quarter, since most of the accounts are out of OTR, we should, on an underlying basis...
we didn't say it is out of OTR. We said that there is no further OTR scheme available.
Okay. Okay. So on margins from next quarter, so this quarter underlying margins was about 2.2 to 2.23 based on the interest income reversal. So how should one think about underlying margins next quarter?
The underlying margins, what is more important is to see the trend in spreads, because that is what will be reflective of the overall efficiency in profitability. Spreads have increased sequentially. There could be some notional entries of reversal of interest, but if you see the operating spreads have improved sequentially.
Right. So my question is, when should we see margins to normalize to like pre 4Q21 levels? If you pre March 21 levels. So when should margins normalize is the underlying question. So we've seen a couple of quarters where OTR has impacted interest income.
Correct. Before that, whatever was the margins, say around in the range of around 2.25 to 2.35, that was the ballpark range which we had been holding before this implementation of the OTR. So we should in a couple of quarters certainly see those levels come back.
Understood. Perfect. Thank you. All the best.
There will be stability in spreads and improvement in spreads to the extent of the interest rate movements, but overall there will be stability of spreads.
Understood. Thanks. All the best.
Thank you.
Thank you.
The next question is from the line of Nischint Chawathe from Kotak Securities. Please go ahead.
Yeah. So just to take it up from the earlier question, what we're saying is that this 250 crores is going to be an ongoing impact till these loans come out of OTR.
No, it will come down. See, because outstanding loan of the OTRs are also going to come down slowly.
Okay. Okay.
Because no further addition will not be there. Now almost it is closed now. OTR is now.
No, that's right. So 250 crores is the base impact that we can see this quarter. This is the highest. Probably next quarter it goes down to.
It will start reducing.
Yeah, that's right. And when do you think this kind of completely gets over?
Maybe in a couple of quarters. It will significantly recede over the next couple of quarters.
So on the expenses side, of the staff expenses of around 147 crores, is there a one-off over there?
There is a one-off around 47 crores, which has happened because of the actuarial evaluation of the retirement benefits. Total around 47 crores is the amount which is there.
And the 100-odd crores establishment expenses, I think that sort of will remain.
Between 90 to 100 will be the ballpark.
Perfect. Thank you very much and all the best.
Thank you.
Thank you. The next question is from the line of Viral Shah from Credit Suisse. Please go ahead.
Yeah. Hi. So just a follow-up on the previous question. In fact, actually more of a clarification. So you are saying this reversal impact in the P&L, which is impacting the margins, is something which will continue every quarter, but the quantum will reduce.
It will keep on coming down. Yeah.
Okay. So understood. Just all other questions are. Okay.
Thank you. The next question is from the line of Piran Engineer from CLSA. Please go ahead.
Yeah. Hi. Thanks for taking my question. I just wanted to understand why would the effective yield change because of the elongation of the term of the loan in restructuring?
Because of the change in IRR.
No, but sir, if you're extending it by say 6 months, wouldn't you charge the same IRR for that extension?
IRR impact will be completely different. India's reporting is based on effective interest rate.
No, I get that. But in that sense, if you are extending, let's say, for 3 months for an OTR, it would not be an interest-free extension of 3 months, would it?
No, it is not interest-free, but there is no cash flow. No? And there is an extension of term. So the term which was 17 years will become 19 years, or term which was 5 years will become 7 years, like that.
So it's sort of a loss of interest on interest, in a way, because of those no cash flows.
Correct.
Okay. And just to clarify, I know this has been asked many times. We reversed 135 crores this quarter. 115 was the sum of 4Q and 1Q?
1Q there was nothing almost, because the OTR started actually towards the end of 1Q.
Okay. But what about then the interest write-backs from the reduction in NPL? That would have actually positively helped our interest income line item, right?
In India, it doesn't matter, no, sir.
Okay.
We will not get into so much of technical discussion. If there is any specific, you can.
Okay. That's fine. No, that was all I had. Thank you.
Thank you. The next question is from the line of Saurav from JP Morgan. Please go ahead.
Yeah, so with just one clarification on this note 6, this corporate restructuring of 5,000 crores, that's entirely developer loans or?
No. It is developer plus IHL plus NHC.
Okay, so of that, developer is about 2,078 crores as you pointed out earlier.
Sorry?
Yeah, of this, developer loans is 2,078 crores. Of this 5,000.
Crores was in the Q2 itself, only Q2.
Okay, and in Q1 it was very low, right? So the total is about 2,100.
2078 was the retail in Q2. 2074 was Q1.
Yeah, so of this, the total developer.
I gave out all the numbers.
Q1 project.
No, so there is a total developer book restructured will be about 2,100 crores. Is my question on this 5,000 or no?
No, 2,100 crores where you got. The 2,100 crores is the OTR done in the Q2. Under
plus
OTR
Q.
2.
Plus Q1.
141 crores.
Okay. All right. And okay, fine. Thanks.
You will find the disclosure given in the in the published numbers. Very clearly it is mentioned the category wise.
All right, thanks.
It is there in notes to the results. Point number 6C. Full table is given.
Thank you. The next question is from the line of Umang Shah from Kotak Mutual Fund. Please go ahead.
Yeah, all my questions have been answered. Thank you.
Thank you.
Thank you. The next question is from the line of Sushmit Patodia from Motilal Oswal Asset Management. Please go ahead.
Yeah, hi, good morning. Sir, if you can speak a little bit about the competitive...
Sir, request you to please...
Can you hear me?
Request you to please stay connected while we reconnect the management, sir. Ladies and gentlemen, the line for the management is reconnected. Mr. Patodia, you may please proceed with your question.
Yeah, hi, good afternoon. Wanted to know the competitive scenario and are you seeing balance transfer out? I just wanted to understand how is it looking? Is there a lot of BT out that's happening or vis-a-vis the earlier trend?
Yeah, now because this quarter you also our traction is very good, especially in the disbursements in the individual home loan segment. We have shown tremendous growth. Nearly 16,000 crores have been the disbursement in this quarter itself, and showing a growth rate of almost 132% over the what we call last one. We have already reached the pre-COVID level there also. Then again, if you look at the portfolio also, there is a 15% addition. That growth rate is very good. It is a very good, especially in the individual housing loan segment. And the way forward, actually, now the rates are at the lowest level, 6.66%. And even the offers given by some builders here and there in some states. Add to that, even the property rates also more or less maintained. And then with all these things now, the initiative by the government for vaccination drive really has helped us a lot. The people are now in a position to move out very freely, then select the properties after visiting them, especially on weekends and all. So we are having a lot of what we call positive mood. Also, we are highly hopeful that the next quarter will be the best one, or far better than this quarter. Of course, the last quarter also has been the best in the history of our company. That also was there as far as the disbursements are concerned.
So how much balance transfer have you had in the last 6 months, if I may ask?
From our side, I think must be not more than maybe within 1 to 1.5% range, maybe there, not more than that.
Okay.
Because now the rates have come down everywhere. We also have given rewriting facility and all. So
Yeah. Okay. And sir, any progress on the Swami resolutions? It's now been nearly 3 to 4 quarters. Where is it? What is the status?
They are more or less same stage only. There is not much of traction we have seen there.
Okay. Okay, sir. Thank you and all the best.
Thank you. The next question is from the line of Kushan Parekh from HSBC Securities. Please go ahead.
Hi, sir. Thanks for taking my question. I had one question. Just wanted to understand what the outstanding provisions are there currently on the restructuring book of 7,000 crores, and what would be the incremental provisions coming over there, as well as how are we looking at overall credit costs going forward?
See, overall credit cost last year was around 60 basis points. Year before that was around 48 basis points. Current year it is more than 100 basis points. But what we believe is that with the further reduction in expected reduction in the NPLs going forward in the next 2 quarters, it should again rationalize, and we should reach somewhere where we were towards the end of towards the end of this year to wherever it was by and large last year. That is as far as the credit cost outlook is concerned. As far as the provisioning is concerned, this provisioning is on the IGAP. As per the IRAC norms of the Reserve Bank, 10% has to be provided on restructured book. Fully it has been made.
And further provisions on restructuring book, we should assume will not come in unless the asset slips into lower bucket.
No, as of now, since there is no change in the NPA position, there will not be any further restructuring required on that book.
Overall OTR is now ended, no? It is not operating.
Okay, understood. And if you could just let us know, is there an increased level of prepayment on the LAP book in this quarter, and any particular reason for that?
No, there is no such any pronounced trend only in the LAP book or anything of that sort.
Okay.
That particular line of business is disbursement is not happening as it was as it used to happen earlier.
Okay, understood. And are we looking at any further improvement in incremental cost of borrowing from coming in future quarters, or this should be the bottom pretty much, the current quarter?
See, overall, if you look at the interest rate scenario in the country, then you will note that the yields have already started bottoming out, and bond yield, GSEC yield has actually gone up. But despite that, we have been able to show some improvement. Some little bit of elbow room is still left, and of course depends upon the stance taken by the central bank on the interest rate scenario.
Sure, understood. That's it. That's all from me.
Thank you. The next question is from the line of Hitesh Gulati from Haitong Securities. Please go ahead.
Yes, sir. Thank you for taking my question. Sir, of the OTR book 3.5% that you mentioned, so is there any overlap with the stage 3 assets?
First of all, it is not 3.5%. It is 7,300 crores, so it will be around 3.1%. Number one. Number two is that there could be some overlaps, but it is generally on the lower side. Most of it will be in stage 1 or 2.
Okay. And sir, last quarter, at the result time, you had mentioned that there was some resolution of 100 crores in July in some developer books, sir. So has that been taken care of when you mentioned there are some small resolutions, or
yes.
What is the state of it?
Yes.
So that was 100 crores has happened?
Yeah.
Yeah, it has come.
It has come, 100 crores come, but that is not from the developer book, that is in the non-housing commercial.
Okay. Okay.
Developer,
so in developer, there is no major.
Very small accounts are there.
Very insignificant.
Very small two-digit account, two-digit amount will be resolution.
Okay. Okay, sir. So thank you. That's it from my side.
Thank you. The next question is from the line of Kunal Shah from Carnelian. Please go ahead.
Hi, sir. Most questions have been answered. Just one question, sir. With the kind of capital adequacy ratio we have, and I understand you're looking at good momentum on the growth aspect, how do we see any requirement of capital, or how should one look at that?
As of now, capital is adequate. After the promoter infusion, as of now, the capital is adequate.
Okay, so we don't believe there's going to be any further need for capital.
That we have not said. We have said that at this point in time, it is adequate.
Okay. Okay. And just one additional question on the employee expense part, right? So you said there is some actuarial impact of 45-46 crores that is there in this quarter. So this will continue for the coming quarters as well, or how should one look at this actuarial impact?
I said it's one time.
It's one time. So okay. Okay. Thank you, sir.
Thank you. The next question is from the line of Maruk Arjania from Elara Capital. Please go ahead.
Yeah, hi. Sorry to hop on the same thing, but if you look at your interest reversal of 250 crore on a book of 7,300, then it roughly works out to 3.5%. And if you annualize it, it's 7%. So is the reversal rate right?
No, sorry, your voice is breaking. Not able to hear.
But we are losing your audio. Mr. Arjania, are you able to hear us?
No.
As there is no response from the current participant, we move to the next question from the line of Shashank Verma from Axis Mutual Fund. Please go ahead.
Hi, sir. I had one query on this cumulative number of provisioning, this 5,354 crores. Does it include the provisioning on restructured book of approximately 700 crores as well as the COVID-related 300 crores provision that we have made?
The COVID-related provisioning is there. 314 crores is included in the ECL provisioning. OTR provision is made under IGAP, under IRAC norms of Reserve Bank of India under IGAP.
Okay. So it will not be included in the 5,300 odd crores number.
It is there. It is reflected there, and the balance is transferred to the impairment reserve as an appropriation.
Got it, sir. Got it. Thanks a lot. Thank you.
Thank you. We take the next question from the line of Chandrasekhar Sridhar from Fidelity International. Please go ahead.
Hi. So this is just to just complete, I think someone was asking a previous question. So if you look at the interest reversals, it would works out, it's 250 crores, which on an annualized basis works out to almost a 7%, interest, which is, have you given like a 1-year waiver?
There is no waiver. There is a moratorium. Moratorium and waivers are completely different things.
Right. Okay. So then you're saying, so in that case, that there should be a write back which will come sometime later, right? Okay.
That is precisely what we are saying.
Okay.
There is no waiver. Please make it very clear. There is a difference between moratorium and waiver.
Right. Okay. Okay. And just secondly, can you just remind me on just over the next 12 months, how much of your bond book is up for repricing?
Not able to hear. Can you please repeat?
Just over the next 12 months, the bond book which is up for repricing?
Approximately around 20 to 23,000 crores.
Requirement.
Thank you.
No, you are saying redemption, no? Repayment.
Yes.
Yes.
Bond redemption.
Thank you.
Yeah. Thank you.
Thank you. Ladies and gentlemen, due to time constraint, we take one last question from the line of Maruk Arjania from Elara Capital. Please go ahead.
Yeah, hi. Sorry, can you hear me now?
Yes,
Yeah.
I can.
Yes, hi. So, just finally on this restructuring thing, so what will be the average tenor of restructuring? Average moratorium in restructuring? 1 year, 2 years, 6 months?
2 years.
2 years. Oh, so that is why the interest reversal looks a bit high, that way? Because it's 2 years.
It is on a valuation based upon the effective interest rate.
Got it. Okay, perfect. Thanks a lot. Thanks.
Thank you. I now hand the conference over to the management for their closing comments. Over to you, sir.
Thank you, Praveen. Thank you for arranging the call, and our best wishes to all of you. Looking forward for a great innings in the days to come, and especially in this quarter. And I also wish all the members and also you all people all a very, very happy Diwali to all of you.
Thank you. Ladies and gentlemen, on behalf of Axis Capital Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.